Good morning from London. This is Bloomberg Markets Today. I'm Guy Johnson alongside Kriti, Gupta. Cash trade just about an hour away. So what do you need to know this morning? European markets are waking up to America's strong ISM manufacturing data. The odds of a June cut from the Fed at one point dipping below 50%. On the other hand, UK shop inflation dropping sharply, and German CPI numbers later today expected to show a similar story. We had France and Italy last week, didn't we? And oil rises as Tehran says Israel killed one of its top generals in a strike on Iran's embassy compound in Syria. Kriti.
In the meantime, a quick check on some of the other markets we're keeping an eye on. Futures not doing a whole lot in Europe. That may change around the open as we get some of these other macro pressures. The 10-year yield is what's catching my eye. 431. We are breaking above that technical level of about 430. We're going to dive into the dynamics of the U.S. Treasury market and what that means for the rest of the world throughout the show. And, of course, that having read through into FX. 107, new weakness in euro-dollar. Markets today starts right now.
So Tuesday, the 2nd of April. Good morning, everybody. Anna's off today. She'll be back in a couple of days' time. Kriti, let's talk about what we got Friday from Powell and the data, and then we get Monday, this ISM print. Tim Fiore, who runs the ISM manufacturing survey, has been kind of hinting about this for ages. The economy, the manufacturing side of the economy, beginning to turn. And we had a strong print yesterday, which has got to be factored in this morning.
Yeah. What's interesting to me is the reaction function of this data, because you can argue it both ways, right? On the one hand, this is good news that a weakening manufacturing sector, which in the United States has been decelerating for a very long time post-COVID. It didn't really matter because services make up more of the economy anyway, so it was kind of brushed off. So a turn in the manufacturing sector, in theory, could be a good thing, but not such a good thing when it's coupled with hot CPI numbers, PPI numbers, you name it. So I could argue it both ways of whether this is good or not. The Treasury market obviously thinking this is a bad thing.
It's thinking it's a bad thing. It's thinking that the Fed is going to have to keep rates on hold for much, much longer. And we're going to see maybe confirmation of that today. We've got a whole raft of Fed speak. I think Powell speaks tomorrow. But we do see a lot of labour market data this week out of the United States. Got jolts later on today. You've got a big payroll number coming up on Friday. Powell has indicated he is highly sensitive to any kind of signs that maybe the labour market is beginning to turn. Now, do we get that this week? And if we don't, does that kind of cement the idea that we push beyond June in terms of the first rate cut?
It's interesting where Chair Powell sits on this, right? Because he kind of backed himself into a corner saying June, July was the anticipation. Fed swaps now pushing it out to July, potentially even further. We're already in April. It's April 2nd. We're getting there. And it feels like there's going to be some emergence of a credibility. I was going to say credibility. I'm trying to merge the two words, so it's not working. But Fed credibility issue again at the same time that we're having fiscal credibility issues yet again in the United States. Read the research over the weekend, and it is telling you those exact two things, that the budget is coming back into focus. Chairman Powell's record is coming back into focus. That's what the banks on Wall Street are talking about.
Ironically, though, all of this seems to be dollar positive. Now, you highlighted, I think, right up at the top, one of the critical things that I'm going to watch this week, and that is what is happening here with euro-dollar. Euro-dollar kind of trading around 107 right now. You think about the data we're about to get today. You think about the UK data we've already had in terms of the BRC numbers. Inflation is coming down pretty rapidly here in Europe. Are we going to end up with the Fed pushing beyond June and the Bank of England and the ECB being forced to go in June, or potentially, dare I say it, maybe even earlier? I doubt that. But let's say they go in June. Where does that leave euro-dollar? How much further down below that 107 level could we go?
Well, this is the snapping back into focus kind of bit that we were talking about, right? Because one of the themes that we've explored on this show quite a bit has been not just the FX market and how it's kind of disconnected from the bond market, but how the nominal bond yields are perhaps disconnected from Fed swaps and what the Fed swaps are pricing in as well. You mentioned euro-dollar. Cable's what's catching my eye. We're at 125 now. I don't love that exchange rate personally. No. But I think it's interesting because we kept talking about the strength in the European currencies relative to a really weak discourse when it comes to the economy. Should euro-dollar have stuck at 107 this long anyway? And now it feels like it's snapping back into focus.
You get a sense that it should go lower?
I think given the economics behind it, yes, because we keep talking about weakness in Germany. We keep talking about how even French numbers were coming in weaker.
Last week,
yes,
well.
Italian, Spanish seems to be the outperformers, which isn't great for the entire Eurozone. It's a very weird discourse. When you have that kind of talk, you shouldn't see strength in euro, and we've seen nothing but the experts that we've had on the show have said that's really a function of the weakness in the dollar as opposed to strength in the euro.
It's going to be, I think it's a really interesting week coming up.
Yeah.
We've also got a stock market that continues to roar ahead. We've got that story which we need to factor in as well. Does that carry on? Is that going to be a problem for the Fed?
Yeah.
I wonder at one point, and we'll talk to Mark Cummer about this a little bit later on, I wonder at some point whether or not you're going to hear those words, irrational exuberance, being spoken by Jay Powell. At some point, does he need to calm this stock market down because it's having such a ripple effect into the wider economy in terms of the spending trends?
I feel like Jay Powell, first off, is having the time of his life when it comes to, I think, financial conditions. And this is why it really matters here. Because remember the last time we saw the stock market at these record highs, I think it was in 2021/2023 as well, pre and post the carnage of the stock market we saw in 2022. And he kind of was trying to talk it down. Now, if you're talking about there's a case for insurance cuts or if there's a case for some sort of softening in the economy that doesn't need to come from the Federal Reserve, doesn't the stock market exuberance, the dollar strength, the tightening credit spreads, doesn't kind of do the job for you?
Maybe.
That's one thought.
Yeah, definitely. It kind of takes the edge off, certainly. The other factor I want to fold in this morning is oil prices ticking up.
Yeah.
And this is something that Americans in particular will feel very quickly, despite the fact that America is producing a lot of oil right now. Geopolitical tension is rising. You've got this. The Israelis have never confirmed this, will never confirm this. Strike on Iranian generals in Syria. This has been ratcheting higher and higher. That then feeds back through into the oil story, plus into shipping costs as well, because you can draw a line between Iran and the Houthis. I just wonder whether this is another factor we need to bear in mind when we think about this inflation narrative, and whether or not this is going to further deter central banks from pushing rates lower.
And it's something that's kind of been brushed off for a little bit. Even the Red Sea tensions, there was a slight blip higher in the oil prices, but that has ultimately been brushed off in terms of the macroeconomic picture. Time and time again, economists have saying if this lasts months, then we'll see a more kind of a bigger hit to GDP, to supply chains, et cetera. It's gone down for months, and we're still not seeing that. And I think that speaks to, again, this theme of resilience that we're seeing in the corporate America and corporate everywhere, really, Europe even. But it's also speaking to this idea that maybe this is something markets aren't pricing in. Take a look at the oil price. To your point, an 87 handle still isn't a massive move. It's grinding higher, but it's not the kind of 4 or 6% moves we're used to seeing off geopolitics.
No, and it'll be interesting to see whether if we do see the tension shifting from the Red Sea to the Gulf, whether or not that's something that ultimately emerges. And the oil market has been very resistant to price that, as you say. I think it's still... We've got an OPEC meeting coming up later this week.
Yeah.
Maybe that's a catalyst. Maybe the fact that the US is producing so much is another catalyst.
Yeah.
I don't know. But there's a number of reasons why you would be worried about taking oil prices too far kind of north. But 70, 80, 90, do you get to 100? There's a lot of people. I think JP Morgan is calling for potentially a move up to those kinds of levels.
Yeah.
That's going to be sticker shock for American consumers as we go into driving season.
Yeah, not their base case, but something that they've mentioned. And again, it's coming back into the discourse because then you have to factor in, you mentioned OPEC, you mentioned the oil exports out of the United States as well. Pemex kind of seeking their way into it as well, which is a story that we don't cover enough in terms of Mexico's read-through into the oil story. Suddenly, geopolitics matters again. Tariff potential matters again. Immigration policy matters again. These are the topics of the research over the weekend. Apparently, when you have a 4-day-long weekend, this is what the economists do on both sides of the Atlantic. I think it's interesting, though, that we're talking about the war story again, because we're still talking about these massive corporate profits on both sides of the equation. You haven't seen it eaten into margins yet. You haven't seen a repeat, frankly, of 2021.
Is there anything that causes a... This is the first time you and I have talked. We're coming into the new quarter. We've got the new month starting. Is there anything... What you've just described as a kind of wall of worry. There's lots of things we could be worried about. Inflation is returning.
I'm a journalist. It's my job to play the doomsday.
Yeah, precisely. and we like volatility. That's kind of what we thrive on as well. We need to see some volatility. But is there an obvious catalyst at the beginning of this quarter that is going to take us away from the narrative that dominated in the last? Where does that catalyst come from? We've talked about inflation. We've talked about Fed pricing. Do rates need to go significantly higher from here? You get a US 10-year that goes up towards 5%. Is that a catalyst to start to unnerve the stock market? You've seen a little bit of that, but maybe not much yet. are higher oil prices. I don't know, where does that kind of, where does the story change as we come in?
But it's the margin of the move, isn't it? It isn't the fact that stock prices are at record highs, or that oil prices are ticking higher, or that we are seeing even yields even ticking higher. It's the 10 to 14 basis point move off the ISM data that we need to be worrying about. The fact that that kind of volatility is more of the concern. If you tick higher and higher to say, dare I say, $100 in oil, hypothetically, but it's done in tiny kind of grinding higher, then you're fine.
We're just boiling the frog. It feels like we're still boiling the frog. We've got all of these kinds of...
It's a very dark comparison.
It is, yeah. But
accurate.
But the temperature is slowly rising.
Yeah.
But the market is comfortable with that because it doesn't perceive, as you say, significant changes. You look at it, you can see it in the options market, you can see it in terms of how the oil curve is shaped. There's lots of reasons at the moment just to think we're going to continue to boil the frog. At some point, does the temperature get too hot?
Yeah.
When does that come? I'm struggling to see reasons on a Tuesday morning after a long weekend for what causes that.
We're going to ask our guests throughout the show that exact question. What is that breaking point, and what else are they watching throughout the week? We're going to give you a couple things to add to your docket. Of course, on today, Germany CPI, that March preliminary data is due today, plus plenty of Fed speak. Bowman, Williams, Mester, and Daly all have something to say, perhaps about what this Fed policy is. Do we start to see a little bit more divergence inside the FOMC? On Wednesday, we've got the NATO foreign ministers meeting, Euro area CPI as well coming in, March preliminary data, plus Jay Powell speaking again, this time on that U.S. economic outlook. Plenty to digest there. And on Thursday, even more Fed. Harker, Barkin, Goolsbee, Mester, Kashkari. Basically, by the end of this week, you are going to hear from every single member of the FOMC, plus get those U.S. initial jobless claims on Thursday. And on Friday, it's Guy's Super Bowl, U.S. payrolls and jobs data coming out, plus that 35th Ambrosetti event kicking off on the shores of Lake Como. We will have coverage out of there as well. Again, plenty to digest from the Fed, plenty to digest on the data as well. We should also mention, I think on Thursday, it is the 75th anniversary of NATO as well. So we're talking about the geopolitics, the tariffs, that all factors in.
It definitely, and that takes us back to that sort of geopolitical narrative, which we're watching so carefully, and what is happening there. I think it's going to be, what I'm really looking forward to this week is finding out whether or not Powell represents the centre of gravity on the Fed.
Yeah.
If he's not at the centre of the FOMC, if he's not speaking for the committee, I think we're going to find out this week. And as you start to see potentially some divergence within that, that raises the risk. You talk about that kind of volatility that maybe we're going to start to see. Maybe this week is where we start to see that within all of that Fed speak you've just outlined.
It's interesting because, yes, there's plenty to digest. Does it ultimately move the needle? We keep talking about it. At the start of every week, we talk about all these speakers and all these data points, and then we end Friday saying, did we learn anything?
Well, this is, but are we just frogs? Are we the frogs that are, things are changing, but
you might be. I certainly am not.
But the increments are so small that we don't necessarily kind of feel that we're sort of experiencing that temperature rise. But maybe actually what we've missed over the last few weeks and months is that maybe there is some divergence. You look at kind of what the message coming out of Atlanta and maybe San Francisco, it's starting to feel a little bit different.
It is, and I think that's where, in the absence of any clear message from the Federal Reserve, yes, we hear these comments from Jay Powell, but in terms of this divergence we're hearing from all these Fed speakers as well, in the absence of that clear kind of unified message, that's where the geopolitics comes into play. That's where what's going on with NATO, what comes on with elections, not just in the United States, but in Europe, in the UK, in India as well, which are coming up, I believe, in the next couple of months as well. All of that's going to factor in, not to mention on Friday. I mentioned NATO on Thursday. On Friday, there's a EU-US Tech Council meeting talking about some of the regulatory aspects on the chip space coming out of ASML, on tariffs, on the Digital Markets Act, all of those companies that are driving the stock market higher, that are easing financial conditions. That could be under some real pressure if we start to see some more of these pressures out of Europe.
The UK and the US signing an AI regulatory deal, starting to see maybe some commonality emerging amongst different countries. It'll be interesting to see whether the EU can get on board with that. I still think the one thing we haven't talked about is the gap that it could emerge here between the United States and Europe.
Yeah.
I think that data today, we talk about all the Fed speak this week, the data today just could reinforce the idea that Europe and the United States are on very different pages right now, which takes us back to kind of euro-dollar Are we heading below 107? Where are we going to go in terms of the numbers on sterling as well? Kriti flagging that one. What are we going to talk about next? We're going to take you back to the car story. Tesla has Wall Street worried. Stock certainly under pressure. Waning demand for electric vehicles and elevated interest rates certainly taking a toll there. We've got delivery numbers coming up a little bit later on. Plus, let's get back to the European inflation story. UK shop inflation tumbling to its lowest level in over 2 years. Supermarkets competing to lure shoppers with low prices. But you are seeing the minimum wage going up this week. You are seeing input cost rising. Can they sustain that? CPI numbers out of Germany as well later on this morning. You got any questions? Kriti and I would be delighted to hear from you. You must have some. You've just had 4 days off here in Europe. Presumably you've got some things you want to be talking about. Let us know. IB Plus TV Go, that's the function. This is Bloomberg.
Right now, there's a bit of a battle going on. The long legs of monetary policy versus the easing of financial conditions. And my personal opinion is monetary policy is not really exerting that much restraint on the economy. And that's why the Fed has been on this path of having to stay higher for longer.
Bloomberg opinion columnist and, of course, former New York Fed President Bill Dudley speaking to Bloomberg Television. Anna Boata joins us now, head of economic research at Allianz Trade. Good morning, Anna. The data, the messaging coming out of the United States over the last few days has signaled that maybe we don't see a June cut, that we are higher for longer. Are you in that camp yet?
Well, we have been long in the camp of those seeing the rate cuts coming a bit later. So we had, for 6 months now, a call for June, which we moved to July. And clearly, we still see signs of having that 25 basis points first rate cut in July. Clearly, the Fed has suggested that we don't need to be at 2% inflation rate in order to cut interest rates. And we do believe that inflation will go to 2% at the end of summer, early autumn. We already have signs, not only in the goods section of inflation, energy, of course, but also in services. All the PMI data in terms of services output prices are showing a deceleration. And clearly, we do believe that the Fed will want to avoid being too disconnected from the ECB, which is also expected to cut interest rates in July for the first time.
OK, so wait a sec. You think that if the ECB cuts rates, the Fed is going to feel obliged to follow suit?
Well, it's more the other way around. But yeah, clearly the two major central banks will start to cut interest rates in the same months. It's true that technically speaking, the ECB will start to cut interest rates 9 days before the Fed, which is new because it's usually the other way around. But all the statements that we have now from the major central banks are clearly pointing to the fact that monetary policy starts to be too constraining. Now, of course, the U.S. economy has surprised on the upside. And then we have seen also with all the expectations of a first rate cut back in March, we have seen financial and monetary conditions easing and clearly being really disconnected at a record high level compared to the real neutral interest rate. So clearly, we do believe that the Fed will want to readjust and to readjust expectations, meaning that it will progressively cut interest rates, 75 basis points, 100 basis points this year, and then continuing next year. Clearly, now the neutral interest rate is somewhere around 3%. So cutting interest rates to 3.5 at the end of 2025, it doesn't bring the Fed into an accommodative monetary policy stance. It will still remain a constraint to the economy. And this is why actually we don't expect growth to be above 2% into next year. And actually we expect growth to slow down in the second half of this year. And this is an important sign for the Fed actually to start to cut interest rates and avoid a much stronger slowdown. So next year we are at 1.6 from 2.4 growth expectations this year. And actually, this is also the case for the ECB. We have now been into 1.5 years of no growth or even slightly negative growth. So it's time to start to cut interest rates. But of course, on a more progressive path. We don't see the ECB being so aggressive as the Fed, so rather more 50 basis points than 170 or 75 basis points as the Fed.
Anna, is growth a good thing? in this scenario, you mentioned the financial conditions easing a little bit. You mentioned the kind of reacceleration in growth that we're seeing in the States. Is this something that is welcomed? If we saw the same data show up in Europe, I imagine it would be met with a little bit more kind of better reception. Is growth a good thing right now?
Well, clearly growth is a good thing by definition, but in the easing monetary policy cycle, it could restrain from cutting rates more aggressively. Actually, this is the reason for which the ECB will be more cautious, just because real wage and real purchasing power from households and the confidence effects will be more positive, and that will create more growth. And clearly, if the Fed would have cut interest rates back in March, that could have accelerated inflation by 0.5 percentage points or more, which means that we would have been above 3% on average this year. And clearly, we wouldn't have seen a first rate cut in July. So, yeah, it's true that if we would have a fiscal policy, for example, that would be much more supportive than we expect and more positive confidence effect from this deceleration in inflation and acceleration in real purchasing power, clearly that could bring some cautiousness from central banks, which would want to avoid any secondary round effects on inflation. Now, the good news is that the cost inflation is behind us. So it's not really what we have seen back in 2022 and even 2023, right? Yep. Even if we have supply chain disruptions, these are manageable, absorbed by companies themselves. And we do have inventory. So even if we have now consecutive and repetitive episodes that do suggest that inflation on the good side might be on the upside, we do believe it will be contained. So it's more about the services. Yeah. And this is where services inflation can ramp up with additional demand, clearly.
Anna, I'm curious about this kind of divergence that you talk about. We're looking at the various factors within the ECB and within the Federal Reserve as well. You mentioned fiscal policy as a part of it. Coming back into the discourse has been potentially tariffs in 12 months' time, potentially a U.S. budget that just goes higher and higher, some scary reports coming out of the Congressional Budget Office, not to mention Bloomberg Economics this morning as well. Anna, is the fiscal threat of the United States something that the Fed needs to be worrying about in the near term?
Well, it's a fair question to ask because it's a very uncertain environment. We do look all at electoral pledges, especially in the U.S., and clearly, if we take it for granted, it will be inflationary. Of course, it will be inflationary. Tripling the trade tariffs will create inflation more than 1.5 percentage points. And easing fiscal policy would actually be a constraint for monetary policy. And in that scenario, which is for us a downside scenario, the Fed would be unable to cut interest rates further. So basically stopping at the end of this year and stalling somewhere around 4.25. But we do believe that there will be more pragmatism, whatever the presidency in the U.S. will be, just because markets are much more worried in terms of fiscal policy. Of course, fiscal policy has helped to cancel half of the monetary policy impacts over the past 2 years. But we can't go in that direction for too long. Clearly, fiscal deficits are now too high, and it's not only in the U.S., but also in Europe. And with interest rates remaining a constraint for growth, clearly there will be an adjustment upcoming. And we hear now also in some of the electoral pledges, especially from candidate Trump, that there would be some pragmatism when it comes to fiscal policy. So I think it would be wrong to actually expect full-fledged tax cuts.
Anna, great to catch up. Thank you very much indeed. Anna Boata, Head of Economic Research, joining us from Allianz Trade. What are we going to talk about next? Turkey's president suffering an unprecedented defeat. Municipal elections this weekend with a story. We're going to take you live to Ankara and discuss the implications of this next. This is Bloomberg.
Welcome back to Markets Today. We're about 30 minutes away from the start of today's trade. When you look at the futures action, there isn't much going on. A slight green on the screen, perhaps a little bit of risk positive tilt. Europeans still waking up to some of that ISM data that we got from the United States yesterday, plus some of the Fed speak looking forward to today. Maybe a little bit of a wait-and-see approach when you look at futures. That could, however, all change at the open. In the meantime, let's go to one of the major stories we're watching this morning. Turkey's president, Recep Tayyip Erdogan, has suffered an unprecedented defeat at the ballot box. Erdogan's AK party fell behind the main opposition CHP in Sunday's municipal elections. It's the first defeat since the president swept to power more than 2 decades ago. Let's get a little bit more analysis here. Turkey's economic and government reporter Beryl Akman joins us from Ankara. Walk us through what this means for the president.
As with a lot of elections, this local election for the president was a gauge on his popularity. Now, in the 2019 local vote, President Erdogan had lost the big cities like Istanbul, the country's economic and commercial hub, as well as capital Ankara. But this time, what made this such a landmark victory for the opposition was that it managed to seize control of Erdogan's AK Party's stronghold in central Anatolia, as well as in some of the cities in the Black Sea. So that is a very prominent defeat, and it comes right after a very prominent defeat for President Erdogan, and it comes right after 10 months after his re-election as president last May. It really shows that a lot of people are unhappy with a high inflation and the worst cost of living crisis that they have faced under Erdogan's 2 decades in power.
If that's the reason, Beryl, do we therefore see the Erdogan government maybe changing economic policy? We've seen interest rates being significantly more elevated over the last few months. We've got a new economic team in place. Do we see changes as a result of this election in economic policy?
We've seen these changes in policy come after the May election when President Erdogan won a 3rd term in office. Well, in the run-up to those elections at the time, the opposition parties and critics were warning that Turkey was heading to a balance of payments crisis and that a policy shift was mandatory. And it was unsustainable. Now, what Erdogan did at that time to buy off electorate and boost his popularity was giving fiscal giveaways as well as cheap credit to boost economic growth, to reduce unemployment and grow economic activity. But all that came at the expense of price stability. So for economists, he really had no choice after his re-election but to reverse those changes. Yep. And he's acknowledged when he conceded defeat in Sunday's vote that Turkey would continue with the normalization path that we've seen since May. But that's taking a toll on people. It's cheering investors who are, yeah.
Beryl, everybody's been watching to see whether or not Erdogan is prepared to stick with the more traditional economic approach, the more traditional monetary approach that is being taken by the central bank, by Mehmet Şimşek, his finance minister. Will this election cause Erdogan to have doubts about that more orthodox approach that he has belatedly taken on board? Does that happen? Are we going to see another reverse going back to the unorthodox approach?
Well, Turkey is prone to policy swings, so that question really makes sense. But this time we've seen no indication from President Erdogan that he would again reverse policy. He has to stick to the current ones, this aggressive monetary policy and even more disciplined budget after Sunday's vote to bring down inflation and get his support back. And investors also don't see any immediate risk to any reversal.
All right, Turkey economy and government reporter Beryl Akman joining us from Ankara. We thank you so much for that analysis. Coming up on the program, we take a look at your stocks to watch, including UBS boosting returns to shareholders with, get this, a $2 billion share buyback. I love this story. We're going to talk about it next. This is Bloomberg.
21 minutes to the market open here in Europe. We come back. It's a Tuesday. Are there new catalysts that we need to be talking about? I'm definitely struggling to find some this morning. But we're back to the idea, Kriti, that the frog is being boiled. All kinds of little changes. You've got a lot of Fed speak coming up this week. the narrative is actually that the US economy and the European economies feel further and further apart. You're going to see that, I think, confirmed today with the CPI
I can't get over the frog being boiled. I hate that I brought it up.
It's either a wall of worry or a frog being boiled. It's one or the other.
Yeah. No, that's fair. The divergence in between the United States and Europe is something we've been talking about for a very long time, though.
Yep.
And I'm curious why it's just now kind of setting into the pricing. Like, why is it happening now that you're seeing extra weakness in euro-dollar when this has been a dynamic?
You pointed it out earlier. We're getting closer and closer to that moment.
I'm sorry, what?
I'm not saying you got it right. I'm just saying you pointed it out earlier. But you probably did get it right. I think we're getting closer to the time at which it's going to happen.
Yeah.
Therefore, the risk that maybe the Fed doesn't deliver actually maybe starts to come into sharper focus.
But now I'm curious, just from a market's perspective, so the economics we can talk about all day, but from a market's perspective, are we 100% sure that that's what's happening, that this is actually a good thing, that U.S. consumer resilience, that this kind of pickup in growth, this pickup in inflation is a positive? Because I could see a scenario very quickly where you start to see a Fed or Fed speakers worried about this kind of reacceleration, worried about the pricing, that this is some sort of 1970s repeat of not tackling inflation full on, which is the exact thing that Chairman Powell worried about and warned about early on.
Which is he more worried about, being Burns or having to be Volcker? And is he more worried about the implications for the politics further down the road later this year? I think is another factor that I think is becoming more and more interesting to kind of trying to figure out. That
and the fact that Chair Powell, one of his early rate cuts was an insurance rate cut against tariffs in the Trump era.
Yep.
I don't know
how one eye on politics.
He does, but I don't know how you even price that in. How do you know like what's going to happen within even President Trump is going to be the president next year? We don't know, and what the time frame looks like. There's a lot to price in. I don't know how to do it.
We're boiling. The temperature's rising. I don't know kind of whether or not we're frogs in this scenario or maybe we're just climbing a wall of worry. But we start a new month, April the 2nd. Are there catalysts that change the narrative? I think is something that we now need to figure out. Let's get the take of Mark Cudmore. He joins us now, Markets Live executive editor. Mark, we come in, we've had a nice long break. We had an opportunity to read lots of things and figure out exactly where we are. But the problem is I'm not sure we're much clearer, and the data are making it more complicated.
I think we are clear. It's just that we're all looking for the scenario that's not happening. We are clearly in a no-landing bull market, and we've been there since the December Fed. That was where Powell basically repeated the errors of 2021, and I heard your conversation there. He's definitely more Burns than Volcker. He was too dovish in 2021, and yet he insisted he didn't want to do that. In December, he's again been way too dovish when the economy did not yet justify cuts. And so therefore, saying that he wants to cut as soon as possible when the economy is strong, when the economy is hot, is just going to lead to another inflationary move again. At the moment, I think the narrative is very clear. It's a bull market for risk assets from the macro side right at the moment. I don't see that change any soon. I don't see any catalyst to change that. And I think the reason that we don't have any clarity is because too much of the world is desperately looking for a negative catalyst that hasn't been on the horizon since December, and I don't see it right now.
Does the shock come from is the shock an equity market shock, though, when it arrives, though, or is it a bond market shock? Is it this realization that actually rates are not going to move? Is that where the catalyst comes from? If the 10-year gets to 5%, if the 10-year pushes beyond that, if the dollar continues to strengthen from here, do other assets other than equities ultimately cause the shock for equities?
I'm not seeing it. Like, I think we're going to get short-term volatility when people realize, hey, the Fed may struggle to cut it all. I don't know why we're debating about whether it's 50 or 75. They're not going to cut 50 basis points. The only reason they'll be cutting 50 basis points or more, and I say even 50 basis points, is because there's an economic crisis out there. I'm just not seeing it on the horizon. I think that every time we get yields higher, then obviously that short-term causes stress for equities. But they're rising because the economy is strong, and that is good for the stock market. It's good for earnings. Consumers are still spending, so the shock does not come from the bond market.
Great stuff, Mark. Thank you very much indeed. Bloomberg Markets Live executive editor Mark Cudmore. Remember, you can get more from Mark and the rest of the team. MLIV Go on your terminal. No landing scenario seems to be the narrative coming out of Mark this morning. Very confident that we are going to see that US economy continuing to power on from here. I don't know where that leaves Europe. Where does it leave other asset classes as well? If Powell is Burns, if inflation is coming back, how do you hedge that?
But is it What kind of inflation is it? Is it services-driven inflation? Is it manufacturing-driven inflation? Is it commodity-driven inflation? I think that's the piece that we're putting together, especially this morning when we're talking about an oil price move as well. To your point, gold also moving higher. And I think hit 2,300 in yesterday's session. It's still higher this morning, about 2,253 that we're seeing on the precious metal. We've been talking a lot about how much of this is driven by physical demand or if it's driven by some sort of hedge or what this actually is, which brings a chart that caught my eye to everyone's attention. I think, Guy, you're going to appreciate this because here is one argument that gold is moving higher because of an inflation hedge. Here on that top panel, let me just walk you through it here. That gold line is literally the yellow line there, precious metal, there you are. The white line is that 2-year Treasury yield. So if you were expecting inflation expectations to come a little bit higher, expecting inflation to stick around, yields are ticking higher. But take a look at what the correlation is doing. We're looking at the 40-day correlation, so a rolling correlation on a monthly basis. You start to see a positive correlation. This is the early signs that gold is actually an inflation hedge. At least it seems to be on the surface.
When it decides that it wants to be that.
Yeah.
And
it hasn't traditionally.
Is it a store of value? Is it an inflation? Because there are periods when it doesn't work as an inflation hedge.
Which you can see on that chart as like the red parts, right? Where you start to see yields ticking higher. People are actively ditching gold. But this was the dynamic we saw in 2021, right? When you saw this kind of cost push inflation driven by supply chain costs, driven by commodity pressures. Gold was the popular trade then, even in 2020.
It's interesting that ETFs have not been part of this narrative.
Yeah.
This has been central bank buying around the world. Is that more to do with concerns around the dollar? Or is that more to do with concerns around other things other than that inflation story? I don't know. It always makes me kind of wonder when people go, gold's an inflation hedge. Because there have been long periods of my career when it hasn't worked.
Yeah.
So you kind of pick your moment. Oh, yeah, it's an inflation hedge. Let's buy some gold. Is something else going on? Maybe. Very
easily, there could be. On the surface right now, that was my initial read, is that what else could this possibly be reacting to? Because this is a recent bid into gold. You've had the same dynamics even in January, which is supposed to be, from a physical purchasing point, the kind of hot time for gold from India, from China, in terms of Lunar New Year, et cetera. And the fact that it's sustained into now April 2nd, that's a pretty big deal.
It is. But I still wonder whether or not that's the reality of kind of why it's happening. Are other central banks around the world buying because they're worried that the US has started using the dollar as a weapon, the weaponization of the dollar?
Guy with the healthy skepticism this morning.
I feel it's my role this morning.
Yeah.
Buy gold seems to be certainly the correlation story when it comes to what is happening with the US front end. Let's see what happens with the US front end.
So skeptical.
Oh, yeah.
Let's bring in our next reporter here, Bloomberg senior energy reporter in Singapore. Stephen Czapczynski joins us this morning. I'm sure he has plenty of thoughts on gold. Stephen, I've got a theory. Guy's got plenty of skepticism to match. Where you're sitting, what is driving this move in gold?
I mean, that chart was really good. I hadn't seen that chart, but, that makes a lot of sense. When you see the Treasury yields rise, when you see these questions about whether the Fed is really going to reduce interest rates, and then gold is rising, and it's not falling, to the degree, it's sort of stalling, but it's not falling, in that May 2023 to December 2023 session, that difference when inflation rises, gold falls, that is the correlation that you usually see. We're not seeing that right now. Now, granted, is it actually the inflation hedge? I'm not going to wade into that fight, but what I will tell you is there are other factors, right? There are people who are worried about China's economy and the health of China's economy. When there are fears about the economic well-being of China, sometimes people will pile into gold. As was also talked about earlier, central banks are also increasing their gold purchases, so that's also kind of bringing it higher as well. So all those things combined, it is an interesting move. And I think for the last few weeks, as gold has hit new record after new record after new record, the narrative had been, well, this has to be because the Fed is going to be unwinding their policy. They're going to be reducing interest rates. But now that it seems that those chances are not deteriorating, but being reduced, it's interesting that gold is staying higher now. So that is something that I think people will be looking at very closely.
I think it's also interesting that Bitcoin is beginning to sell off a little bit. Just kind of put those two things out there at the same time.
You're killing me.
Let's talk a little bit about, I want to get your take on what's happening with this oil story. So you've had this Iranian story that their compound in Syria was bombed by the Israelis not confirming that, killing 2 generals, killing a number of senior officers. Oil is reacting to this, but reasonably cautiously. At what point does the oil market start to become seriously nervous about a significant escalation in the Middle East that will impact the oil price? What do we need to see? And what was the news over the last 24 hours in any way a clear kind of signal as to when that may happen?
I think that, and when you talk to people in the market, there has been fear since, the late last year that any sort of conflict, whether it's direct or whether it is, sort of a behind-the-scenes conflict between the United States and Iran, if you see any more ratcheting it up of pressure where the U.S. were to put sanctions on Iran, harder sanctions on the export of Iranian crude, that would sort of be the next escalation. I'm not sure if we're at that stage yet, and it's been something that people have talked about for months. There was this expectation that the market was going to be nervous, especially as the situation between Israel and Hamas has escalated over the last 6 months. But I think what's driving oil right now, well, certainly the Middle East, there is this risk premium. What's driving oil right now is just pure supply-demand fundamentals, and it's really on the supply side of things. When you have OPEC Plus reducing, they've held their cuts through the second quarter, and then Mexico yesterday has canceled. Bloomberg reported yesterday that Mexico canceled some deliveries to refineries in the U.S. and other places. So that's kind of reducing some crude from the market ahead of the election in Mexico. Overall, you're sort of getting this picture of a tighter market, and that's kind of driving things up to the $88 range. And people even talking about $100 barrels of oil again. So you really have these two sort of situations where you have the fundamentals, but at the same time you do have the risk in the Middle East. Where does that go from here? It really is a response. What does Israel do? What does the U.S. do in response to any more action from Iran? It's really the ball's in their court at the moment.
Certainly something we're watching very, very closely. Bloomberg's Stephen Stepchinsky joining us this morning for a little bit of a commodities roundup. We thank you so much for your analysis. Let's go from the commodity story to the stock story and get our stocks to watch this morning. Joe Easton from our equities team has the latest. Joe, walk us through it.
Morning, Kriti. So UBS announces today that it will start a $2 billion share buyback beginning this week, and it says it aims to return to the same level of buybacks it did before the Credit Suisse takeover within the next 2 years. Now, this follows them announcing in February that they would restart share buybacks. Now, this stock has actually had a good run this year, but we thought we'd put it into context of the record high that we saw before the financial crisis. We can see it's down around 60% since then, still a long way to go, but analysts are starting to see the benefits of this Credit Suisse takeover, and the shareholder returns potentially a positive for that stock this morning at least. But there's that long-term move there, as I say, a big discount to those record peaks of more than 15 years ago. Then in terms of renewable energy, we're looking at Vestas, the Danish wind giant, announcing a swathe of orders over the weekend, including a massive one over in the US. Now, first quarter orders are actually totaling just under $2 billion, according to analysts. But that is a bit of a slide from the boom that we saw in the fourth quarter. So analysts at Citi saying that this is actually potentially below consensus, and there might be some disappointed analysts on the street today, given we can see 23 buys versus 5 sells. So clearly the street is positive on the stock. Potentially a little bit of weakness in those orders this morning for Vestas. Finally, over in UK fashion retail, we've got another update on Superdry. The founder, Julian Dunkerton, announcing that he now won't make an offer for the company. That had been speculated very much recently. The two parties say they couldn't agree on the correct path for them to go ahead, and now Superdry might be looking instead to do a share placing that would potentially come at a discount. Dunkerton himself says he might underwrite that deal. Now, this is another one worth looking at the long-term view. Again, it's had a bit of a tiny uptick this year, but over the longer term, it is a massive decline. It's now very much a small-cap stock, previously traded at £20 a share, and we can see it now trading at about 28 pence a piece in terms of the stock. 28.80, there it is on the screen. So a massive decline. Keep an eye on Superdry later today.
Joe, thank you very much indeed. Joe, interested on the stocks you want to be watching this Tuesday morning. Kriti, what I did read over the weekend was a number of pieces suggesting that US investors are looking to Europe now to kind of broaden the rally out a little bit.
Yeah.
Now, we've been caught by this trend a number of different times, and you do wonder what is going to be the catalyst ultimately to get European stocks moving here. Is it just that they've run out of things to buy in the United States and they're now going to be buying Europe? There kind of feels like there's an element of that right now.
There is. The timing is poor, can I just say, as we talk about the idea that, well, this might be the kind of turning point, at least that we're seeing in the FX space or that we're seeing in the bond space, where we talk about this divergence. More and more people seem to be more awake to that prospect, at least when you look at the initial market reaction this morning. So why would you dive into the equity picture right now? The flip side of that argument is if you are expecting a weaker euro or a weaker pound or weaker name your currency here, is that just making the entry point into some of these stock markets more attractive? Potentially, yeah. So that could be one factor that we certainly need to be looking at. The other one is that many of these companies have big US earnings, big dollar earnings, so maybe that translation effect actually looks pretty good. So that could be a factor as well. So I think the FX story is going to be quite interesting to watch here. If we do see a move down to kind of below 107, 105, people have been talking about parity as well. Yeah. Is that going to be a catalyst that makes Europe look better or worse? Yeah. That's always been the really tricky one. It tells you an underlying story, but maybe gives you a fundamental reason maybe to look at it. Yeah, you talk a little bit about it as kind of a catch-up trade. This at its core is more of a valuation trade than maybe a fundamentals trade, and that at what point does the stock market look good as opposed to let's buy in on European strength or European stock stories. There's a lot to digest there. We're going to dive in with the market open coming up in just a few seconds, really a few minutes. Futures pointing higher. Stick with us. This is Bloomberg.
Couple of minutes to go till the start of trade. It's Tuesday, the 2nd of April. I'm just telling Kriti, I'm struggling for a thing this morning. There doesn't seem to be an obvious kind of narrative to get your arms around. Yes, we've just had this. We had Powell Friday. We've got the PCE data Friday. You've got the ISM print Monday. Markets didn't really price that in. You've got to kind of price that in over into Europe this morning. But how much has really changed? We're coming into the beginning of a kind of new quarter, new month is starting, kind of how much is changing there. There doesn't seem to be an obvious kind of theme to get markets moving in a slightly different direction. So it's just a continuation. Just feels like more of the same is what we're going to be getting. It is, except what I'll say is maybe that is the theme. The fact that nobody is starting day one hopping into the basket. Because if you look at what happened in the U.S. session yesterday, you saw stocks sell off. It was a negative session. A lot of that coming in from the eco data, yet futures pointing higher in Europe. Why the optimism? Why is there not that sort of catch-up trade this time around? And for me, that's the question. Although it is coming on a day that you are seeing European weakness, I think it's a macro day. I'm curious to see what the commodity names do, what the miners do, what the oil names do. Maybe some of the oil names as well. Yeah. I think there's individual little stories. So there's a kind of story around BAE Systems this morning. It's got a big contract that's won over in the United States for armored vehicles. That kind of speaks to that kind of dollar story, which I think is interesting, which you can fold in and think about. I think your kind of story on gold, I think, is worth paying attention to as well. How does that get factored in? But I don't think there's an obvious reason for European markets to do anything different this morning. Come back to work after a 4-day holiday, having kind of done a lot of reading and tried to figure things out. I'm not sure how much more has been figured out. I'm venturing to say very, very little. You mentioned a BAE Systems. I've got my eye on Telecom Italia, actually. There's a Starlink story that I'm sure we'll talk about at some point. But this is preparing us for the market open here. Just a few seconds, markets are officially open. Not a huge amount of changes when you look at the FTSE 100. It is open, but again, marginal changes around the day, I guess. I mean, that's very marginal. Yeah, there's nothing I can even say here. So ASML is up a little bit this morning, which I still haven't actually put my finger on in terms of why that is. You are seeing some of the pharmaceutical names just giving back a little bit of ground. So GSK is weighing on the FTSE 100 this morning, but you've also got Sanofi down a little bit as well. Yeah. That feels a little bit more cautious in terms of this market. Vestas not reacting positively to the deal flow story we saw over the weekend. But you've got ASML up, Novo's tracking a little bit higher. To your point about the oil stock, Shell is tracking a little bit higher. Total's having a better morning as well. So there are kind of things, and Astra's actually just moved up as well. So it feels like a very mixed market. Again, looking at the single stocks, where's the clear narrative here? Is there a clear narrative which is moving things around? I can't see it from the sector point of view either. You are seeing maybe the basic resources popping a little bit higher. The oil stocks are on the move as well. So maybe there is a commodity theme. But again, where's the thing? The thing that has changed here, I don't think there really is one. It's interesting that the FTSE 100 is up by nearly 0.5% this morning, to your point about kind of maybe that negative stock story in the States yesterday. But you do have Shell tracking high. You do have BP up. You do have AstraZeneca up this morning. So it's easy to see why the FTSE on those three single names, at least, will be moving up.
The other ones I'll point out is the banks index. You are seeing kind of interspersed in terms of index contribution with some of the oil names. Some of the banks as well. HSBC, for example, Standard Chartered, Barclays higher this morning, even Lloyd's higher this morning, which is interesting because when you look at the actual bond market, there isn't that much of a move in yields. I'm wondering how much of that is an expectation on the back of that. But as you pointed out, Glencore, ASML, HSBC, your top movers this morning. To the downside, one of your favorites, though, Schneider Electric. This is part of your sensational six.
So this is the stock that everybody's paying attention to at the moment because it provides basically the network, not the networking gear, the infrastructure around the electricity that sort of provides the AI story. And I think a lot of people are looking for that second derivative, third derivative trade. Schneider keeps being mentioned potentially as one of those names. But yeah, not a massive move in the bond market. Interestingly, you are seeing maybe a kind of a little tick higher, which kind of makes sense given what we've seen in terms of the ISM data. And I think this is going to be a problem that Europe is going to have, is that if we do see this divergence in terms of the economic data, to what extent is the transmission of rate cuts going to be muted, blunted in Europe by the fact that if the Fed wasn't going, you would see Treasury yields getting a lift?
That's a lot of domino effects I'm trying to kind of put it all together in my head because the risk to all of that is you see some sort of spurt of growth in Europe, which I realize is unlikely, but isn't that exactly what people said about the States? And I can recognize that, of course, the EU and the United States is different.
Yeah, in the same way.
Yeah. At a time when you are starting to see, I think there was a story over the weekend that balance sheets were kind of shrinking in a lot of European currencies as well, or countries, excuse me, as well, off the back of some of the kind of bonds maturing. And that makes a lot of sense. You got to bring them into the credit story as well. But European growth it's not weakening to the same extent that I think a lot of people expected it would. There is no dramatic downfall.
So that's true. But I guess the problem would be if, say, the Fed, Mark Cudmore, he doesn't see the Fed cutting at all this year. We're getting a no landing. Say the Fed does not cut and the European economy still doesn't look great, and you've got the Bank of England and the ECB forced to cut.
Yeah.
That divergence is going to be very dramatic in terms of what you're going to see likely priced into euro, dollar, sterling, whatever else is going on.
Doesn't it just make the trades easier, though? Isn't it just a no-brainer trade?
It would be a very easy dollar positive trade, and I think that would be the interesting thing. So it can come down to timing. Now, June, July, I don't think it's going to make much difference, but Anna Boata at Allianz talking to us earlier about the fact that she thinks actually the Fed will punt maybe a little longer, and we could see maybe a July cut rather than a June cut.
We had for 6 months now a call for June, which we moved to July. And clearly, we still see signs of having that 25 basis points first rate cut in July. Clearly, the Fed has suggested that we don't need to be at 2% inflation rate in order to cut interest rates. And we do believe that inflation will go to 2% at the end of summer, early autumn.
So it's interesting. You are seeing the read across from the US strong data yesterday into European bonds this morning. Take a look at what's happening in the gilt market this morning. Big move, despite the fact that you see BRC data suggesting that actually shop price inflation is coming down very rapidly, yet yields are higher. That's the gravitational effect that the US market is having. Thanos Momvakidis joins us now, global head of G10 FX strategy, joining us from Bank of America Global Research. Morning.
Good morning.
The dollar story is going to get potentially very interesting here. And we got a 107 handle on euro dollar. You've got US data that is looking really strong right now. You've got the JOLTS data later on today, but you've had ISM suggesting that actually the US manufacturing sector is picking up. You've had an idea that maybe the dollar weakens from here. Is that now being called into question? Kind of where are you questioning? Are you worried that actually we could see a significant dollar strength here rather than dollar weakness?
We have been expecting a strong dollar early in the year because the market was pricing too many cuts too early. Eventually, by the end of the year, we have a weaker dollar, but based on two assumptions. First, the US economy will slow, and second, related to that, the Fed will start cutting rates. Obviously, the risk is that it will take longer. The US economy has been very resilient. Inflation has been sticky. And particularly with the labor market so strong, there is no reason for the Fed to start cutting early. Even if they start, every cut afterwards will be data dependent. It will not be a normal easing cycle. So there is a risk, as long as the US economy remains in a non-landing scenario, that it will take longer.
How big a risk is there? You have this at the end of the... Where do you have us at the end of the year?
We have it actually, euro-dollar 107 for the first quarter, 110 for the second, 115 by the end of the year. This is still, 115 is halfway towards the long-term equilibrium 120, and this assumes that we get 3 cuts by the Fed this year, which obviously is not a given.
Okay, so as we work our way towards that, is the risk growing now that we don't get that? That actually the risk is that potentially the Fed doesn't cut, or we get very few cuts, maybe 1 cut, according to Bostic, and we see 2 or 3 cuts coming through from the ECB. In that scenario, isn't there a greater move? Potentially, you could see a move down to 105, 103, potentially parity. How big a risk is there on that front?
Yeah. If we're in a scenario in which no central bank cuts this year, then we can see euro-dollar 105. If the Fed does not cut, but the ECB and other central banks cut, then we can go to parity. If we have new shocks, an oil price shock, even if no central bank cuts, we can go below parity. So these are roughly the forecasts.
You said 115 by the end of the year to come in line with the 120 long-term average. Why 115 by the end of the year? I can appreciate that it is a American-driven story by that, but doesn't that create just this massive dislocation on the European front, especially when comparing to the long-term average of 120, when some would argue, critics of that would argue, that if you look at the last 10, 15 years of European economics, it wouldn't necessarily favor 120. It would favor something weaker than that.
I mean, our baseline assumes that we get some slowing of growth in the U.S. and that the Fed cuts matter more than the ECB cuts. But we also have the U.S. economy still growing much faster than the Eurozone economy.
Yeah.
Now, if we're in a scenario in which, as the U.S. economy starts to slow, the European economy starts surprising to the upside, then we can go closer to the 120 equilibrium.
What is the likelihood of the European economy surprising to the upside, though?
Not very high, but having said that, recent data has been somewhat better. From a very low base, but has been somewhat better.
So not very high, but you're still expecting the long-term average to kick back in. Why is that?
The Fed starting to cut rates is a big deal because the Fed cuts have global implications. But given that the US economy is resilient, the risk is that it will take longer and we're going to have a very shallow easing cycle even when it starts.
A European central bank is going to have a problem. This morning, so BRC data comes out, shows the fact that the UK grocery price inflation is falling really rapidly. Yet what do we see? We see gilt yields at a 10-year tenor ticking higher. Is there a danger that actually we don't see rate cuts that are delivered in Europe being transmitted to the economy because the Fed is going to wait and US rates are going to stay higher and term premium is going to be higher in the States because we're all increasingly worried also about the deficit and what is happening with the debt load as well? How big a problem is there going to be in terms of the disconnect between what happens in Europe in terms of policy and in the United States and how that relates to the rates market?
There are 2 issues here. First, rates markets are strongly correlated. So whenever the market prices the Fed, it reprices everybody else. Second, even though European inflation has been falling faster, we're still above the target, and the labor market, both in the Eurozone and the UK, is still extremely stretched. So even if the ECB and the Bank of England start to cut before the Fed, they are likely to be very cautious simply because they are dealing with a labor market that is very tight and wages are increasing. So they will continue actually being data dependent. It will not be a normal easing cycle.
You go. I'm still processing.
Okay. Okay. So let's talk about sterling. Let's talk about sterling a little bit. The governor seems very keen, and I wonder whether Jay Powell provided him with cover. I was fascinated to see the timing between what Jay Powell said and the governor's FT interview, where he talked about the fact that he has a predisposition to cutting. He wants to cut. He sounded much more confident in his ability to cut. If Powell turns around and says, actually, the data probably means that we're going to cut later, How does the language change in Europe? How quickly does the language change in Europe? Are we going to have a communication crisis as well, where central banks in Europe get kind of left high and dry by what the Fed does?
I think both the Bank of England and the ECB will make the point very strongly that they don't depend on the Fed, but the market will doubt that this is the case. Now,
how do they communicate? That becomes incredible at some point.
It will be a challenge for them to do so. They do have different policy reaction functions. In the case of the UK, although inflation remains higher than in most of the rest of G10, it is falling faster, particularly given what was going on last year. In the case of the Eurozone, inflation is much lower than in the US. The data is weaker. But the ECB is more hawkish for a number of reasons. So they want more evidence that they're approaching the 2% inflation target.
Yep.
And again, they focus a lot on wages, rightly so, because despite what's going on in the rest of the economy, if the labor market remains tight, the unemployment rate is stuck at an all-time low, wages keep increasing, they have to be very cautious.
We're talking a lot about the labor market in the States and in Europe. I'd like to talk about the labor market in Japan in particular. We're talking a lot about this low FX volatility that's still kind of game theorying what happens with the ECB, what happens with the Fed. In the meantime, while we're waiting for some sort of real decisive direction from either central bank, is the BOJ more in focus? Is the carry trade with the yen still the go-to trade? And how long will that be in vogue?
Now, Japan is a completely different case. Inflation there is a solution, is not a problem. They are happy to see persistent inflation. It is above the target, but not that much higher. And they have a long history of 30 years of deflation. They managed to exit their conventional policies without actually causing a market panic. If anything, actually, it didn't really look like an exit. So we think that they will remain very cautious, leaning on the other direction compared to other central banks. And to a large extent, dollar-yen depends on the Fed. If the Fed does not cut rates, dollar-yen can go to 160. If the Fed starts cutting rates, it can go to 142.
How big a risk is there of intervention near term, today, tomorrow? That's a scenario that may emerge over the next few weeks, months. How much pressure is there potentially at the moment for the Bank of Japan, Ministry of Finance, to do something in the near term? And is the market ready for that risk?
I think it is expected. I think it is very likely, but it will be more like leaning against the wind. They know very well, also from past experience, that these interventions, they don't work. It's mostly a threat, so that they will create some caution in the market, some two-way risk. But I think they know very well that everything depends on the Fed. If they just buy some time with their intervention until the Fed starts to cut rates, it will be fine. But if the Fed does not cut this year, there is nothing these interventions can do.
But you said if the Fed does, you could see dollar-yen at 160. What levels do the risk of intervention increase at? I've seen numbers anywhere from 152 to 155. What numbers are you looking at?
I think 152 is a critical level at this point where we will expect intervention. In the scenario in which they do expect the Fed to start cutting this year. But if the market prices no cuts for this year by the Fed, they will realize that the level will be higher. So they will be more flexible in this case, as long as it is driven by forces that are external to Japan.
Let's see this morning. Thanks for joining us. Stanis Lambakidis, Global Head of G10FX, joining us from Bank of America Research. Quick look at the core six here in Europe to see what's kind of happening there, to see what's going on with the main stocks that we focus on. Little weakness in Ferrari this morning, which I think is interesting. But elsewhere, you do see Novo Nordisk rising. You do see LVMH on the front foot. ASML is also significantly higher. So generally, European markets feel much more on the front foot than you would have surmised, maybe, by looking at the price action coming out of the US yesterday. Let's dig further into the individual stocks. Joe's here with the details.
So UBS shares actually pretty much little change now, up 0.2%. This stock up 48% over the past 12 months. So this news of a $2 billion buyback perhaps already priced into the market, given what we're seeing with that stock, little change. It actually slipped slightly at the open. One stock that's dropping pretty sharply is Vestas, down 3%, was down a bit more than that. The weakness in the orders is what analysts are pointing to, around $1.9 billion of orders in the quarter, but that is below expectations. We brought up Telecom Italia, a bit of a row, interestingly, with Elon Musk's Starlink. Starlink accusing Telecom Italia of withholding data that the company needs to roll out its high-speed internet in Italy. So that is interesting. We're waiting to see any further declines in that one. Down 1% at the moment, so a pretty decent move. But the big dropper today is Superdry. Take a look at that one, down 50% as the founder, Julian Dunkerton, announces that he won't now make a bid for the company. That had been the key prospect for the firm, and they're talking about potentially a discounted share placing in order to give the fashion retailer some of the cash that it needs. As we said in Stocks to Watch, that stock used to trade at £20 a share. It's now trading at 14 pence. You can see the demise of that stock quite clearly. We'll take a look at some chip stocks as well, because there's a couple of bits of news in this. Firstly, we've got a report that Samsung is potentially lifting the prices of some of its computer drives around 25%, according to reports. ASML gets 20% or more of its revenue from Samsung alone. We're seeing a gain there. Also, BE Semi has a broker upgrade over at Barclays, and a couple of other positive stocks, Infineon, ST Micro. The other thing we're seeing is a report of OpenAI potentially building a massive data center with their investor Microsoft. That would potentially be used for their OpenAI ChatGPT rollout, according to reports. We'll wait to confirm some of that one, but positive in terms of those shares today. In terms of the UK, it is all about those gilt yields that you mentioned. We're reopening after that big move higher, around 10 basis points in the Treasury yields yesterday following that US data, and as such we're seeing Persimmon and Taylor Wimpey declining, and home builders also had that data showing UK house prices declined, and similarly we had data showing retail prices also slipped as well. So brought up Tesco and Next, but a bit of a move lower in the home builders today for those gilt moves and also that house price data. In terms of your morning calls, going to bring up RWE, this one out of Germany. It's downgraded by Exane BNP. It's had a terrible run, this stock, with energy prices coming down, and Exane is bailing on their buy rating today and sending the stock lower by around 0.9% once again. And a final one is Barclays. We're doing the UBS buyback, obviously, but another one to keep an eye on in terms of Barclays is this one. This is a buyback-driven story. Jefferies given the stock a street-high target. Believe it, there it is, 330 pence a share. The stock trading at 185. Massive gains expected, according to Jefferies. They could return £11 billion worth of cash to shareholders over the next 3 years, and they give it a street-high target, and that one is up 0.8% today.
All right, Joe Easton from our equities team, we thank you so much for walking us through some of those early movers. Coming up on the program, Tesla may be headed for a gloomy milestone as waning demand for EVs takes its toll on their sales. That story next. This is Bloomberg.
Tuesday, the 2nd of April. Welcome back. Actually, I think equity markets aren't where the story is this morning. You've got equity markets broadly rising, which I think is interesting in the light of what we saw yesterday over in the United States, where we saw some weakness given what we saw with the data. This is understandable. The data suggests maybe some strength, actually, in manufacturing, which means rates maybe stay higher for longer, which means potentially that's bad news for equities. What you are seeing this morning, I think, in Europe, which is interesting, is a big move in the bond markets. So you're seeing yields sharply higher, despite the fact that actually the data are pointing to weaker inflation. Let's talk a little bit about some of the single stocks that we're going to be watching throughout the day. Keep an eye on the auto sector. Tesla is going to be a big focus of attention, maybe heading for a gloomy milestone as waning demand for EVs, electric vehicles, and elevated interest rates maybe continue to put a downward pressure on some of these sales. Analysts have been rapidly lowering their projections ahead of this week's deliveries report. Joining us now is Bloomberg's Craig Trudell. Craig, last year we were shooting for the moon. The story was amazing. Everybody was pricing the stock sharply higher, but we were starting to get early indications that actually maybe sales weren't as strong as anticipated. We're now getting strong confirmation of that, and the stock has reacted. What are we going to get that adds to that story today?
Yeah, I think what we're seeing is broadly payback in the sense that the stock performed so well last year despite some weakening of fundamentals. And some payback in the terms of just operationally, this was a company that slashed its prices at just an unprecedented rate last year. And it's just something you don't see. You don't see a company that has a really strong selling model like the Model Y make that 20, 25, 30% cheaper in the course of a year. And so, the way that they sort of pushed on a string last year to juice sales, how much can you continue to do that, sustain that when you have fleet purchasers that are going to balk at buying in the future when you've essentially nuked the resale values of the vehicles they have in their fleets. And so we're seeing it was remarkable as the quarter was coming to a close just how much consensus was coming down. I think my favorite example here is Deutsche Bank, where they started the month of March at 476,000 was what they were expecting. They took that down to 427 on March 11th, and then just last week took it down further to 414. Wow. So the amount of sort of dramatic moves by these analysts was not something like I've seen before.
Where's the pressure points, though, in scaling up? You mentioned that kind of more affordable model as well. Where's the hiccup there? Is it a supply-driven hiccup? Is it a marketing-driven hiccup? What is it?
I think what was really interesting in the Walter Isaacson biography that published late last year was you had indications that Musk's team was kind of having to press him on we need a cheaper model. And it was kind of a remarkable bit of writing in the sense that Musk himself talked about a $25,000 Tesla years ago.
Yeah.
At the 2020 Battery Day, he was talking about that being something that was in the works. And then it kind of got put on the back burner. He had kind of convinced himself that Tesla was going to be able to bring a driverless car to market. So why worry about, building out the lineup if they're on the verge of this, hugely, game-changing technological development? The fact that, the driver assistance system may be very competitive, but it is not capable of driving the car without you supervising it. And therefore, it's not fundamentally changing the industry like he hoped.
BYD, Xiaomi, Chinese manufacturers pushing ahead. Like you've seen the sales coming through from BYD, that they are getting stronger and stronger and stronger. Now, they may be being juiced by discounts as well, but there must be an implication for Tesla.
Absolutely. And so this is a case where, in any other sort of situation, you would perhaps lean on exports. But we find ourselves also in a very difficult position in terms of, here in the EU, we're going to likely see in the next few months increase in tariffs. Yeah. And so there's, not a whole lot of options here other than to continue to compete on price, which is what we're seeing across the industry. We've seen what that's done to margins for Tesla, and it has not been
Greg,
good.
Yep. Certainly, big impact. Craig, thanks very much indeed. We'll look for that data a little bit later on. Coming up, we're going to be talking about what is happening with the UK house price story. The head of UK residential research, Knight Frank, is going to be joining us. Nationwide data. Maybe we're starting to see a little bit of a tick up, but it's going to be slow. It could be a bit of a grind, but at least potentially maybe it's moving in the right direction, certainly from a housing point of view. That's next. This is Bloomberg.
This is Markets Today. We're about 30 minutes into the European trading day now. The stock market it's in the green, but there isn't anything really driving it. Some would argue it's a little bit of still processing some of the news that we got out of the States yesterday. One notable outperformer driving the FTSE 100 higher is going to be the banks index. That seems to be more a result of what you're seeing in the bond market than the stock market, especially when you have gilt yields higher by 11 basis points. The U.S. Treasury market not doing a whole lot, but perhaps processing some of the data that we got yesterday.
We saw the ISM print yesterday come through, particularly the prices paid component within that data, telling us that actually you are seeing a re-emergence of manufacturing inflation in the States. And the manufacturing data is picking up. Tim Fiore, who runs that data series, has been talking about this for a while. He talks about us bumping along the bottom, but we're now starting to re-accelerate. And there's an interesting inventory story around that. It just pushes the Fed out, doesn't it? And I think it's going to be a real challenge for the gilt market, for the bond market, just to deal with this idea that maybe we do see divergences across the Atlantic. And you're still going to see that big gravitational effect coming through for gilts. off the treasuries. And that's going to be a problem, I think, for the Bank of England and the ECB.
So I can put together the read-through from the treasury market yesterday into the gilts market today. What I can't put together is why the treasury market reacted so aggressively to this ISM data to begin with, especially when, to your point, yes, it's a kind of move higher in the manufacturing data, but it is still manufacturing data in the States, which is less of a read-through into the general economy.
I think it was the prices paid bit that I think maybe caught people's eye. The fact that we are starting to see that inflation rate ticking higher again.
Yeah.
The whole idea is that we're seeing disinflation, and that is being led by the manufacturing sector. If even the manufacturing sector is starting to see a reacceleration of inflation, then that's maybe slightly more problematic.
No, absolutely. It's just that there's a reason people brush off this data, and there's a reason there isn't always this knee-jerk reaction on it.
I think it used to come out at the beginning of my last show every day. Every time I saw it, I was always surprised how big a reaction there was, particularly to the prices paid bit. That's the bit that seems to have been, and the labour market data as well. Those are the two kind of areas.
The fact that the employment numbers are factored into that data.
Yeah, exactly. Here in the UK, I think it's a different narrative. So inflation, it's interesting to see what's happening with the inflation data. So UK store data dropping to 1.3% in March. This is the BRC data compared with 2.5 in the previous month. So this is data we get from the British Retail Consortium. So this isn't frontline headline inflation data, but it is the lowest level since December 2021, before inflation started to ramp up as a result of the Russian invasion of Ukraine and how that hit food prices, etc. Now, what is the other aspect to this is that what you have seen this week as well is the minimum wage going higher. You're also seeing fuel prices going higher. These are input costs that the big grocers here in the UK are going to have to deal with. So does this data continue its downward trajectory, or does the cost story put a floor underneath it that are ultimately going to be passed on to consumers? Sam Armstead joins us today from the Markets Today live blog. That's the interesting conundrum here, really, isn't it? We've seen inflation coming down, but you do wonder whether that's going to be continuing. Actually, I wonder whether the bigger story actually this week on the inflation front is what's happening with the minimum wage.
Yeah, so that's a really... So the BRC data, I think, gives you... You're sort of saying it's not this overarching data. But what it gives you is this nice information as to how that food price data is coming down, right? So food prices are coming down anyway. So you get a combination of inflation on there coming lower, but also this intense competition between grocers. And with this report almost every month, that is one of the key driving factors. So as you say, those input costs are going up. Now, for the grocers, most of them have already put their wages up. So they are going to face a little bit of an extra cost on that, but not a huge amount. But
their suppliers.
Their suppliers, exactly. And then also there is a limit to how much more they can cut. They're already operating on very, very thin margins. And so there is a limit to how much further that can go down. And so I think as you reach particularly to the middle of the year, you may see that slow a little bit.
This move that you're seeing in the bond market, though, this gilt story, is this a catch-up trade to yesterday, or is this reacting to the data you just laid out?
I think it's a catch-up trade, yeah. And I think, something to note as well with the FTSE 100, you mentioned banks already, but one of the things pushing the FTSE 100 today as well is the commodities story. This is the thing that, the exposure of the FTSE 100 has to oil companies, mining companies, has held it back from keeping up with the records that you've seen in Europe and in the US. But today, and actually, just generally in the last couple of weeks, as the story particularly on iron ore and copper has got a little bit brighter, and as oil has continued to sneak higher, that's kind of what's pushing the FTSE 100 today.
Net, though, are we going to end up in a situation where the Bank of England is looking at inflation data that is coming down, that has come down, is predisposed, therefore, to cut, despite what Haskell and Mann are saying, and actually the transmission through to the real economy is going to be blunted because of what is happening with the Treasury markets? Is that going to be a scenario that potentially we could be heading towards here, that... Yeah, the Bank of England cuts, the front end moves, but actually the shape of the curve really sort of moves off the back of that because longer dated bonds, longer dated gilts here in the UK are really responding to what's happening in DC.
Yeah, and I think that's been the story, and I think that's going to continue to be the story with gilts in particular. So the question and the sort of debate that has been raging really in the last couple of weeks is whether the Bank of England is going to lag or whether it's going to cut first, right? If they do lag the Fed, that's going to continue that story. The gilt markets in particular are going to continue basically to move with Treasuries rather than really on what the Bank of England is doing itself.
Should the gilt market and the Bank of England as an extension be paying more attention to the housing story here as opposed to what's happening in the States?
I think so. I mean, the housing market data we got this morning, the nationwide data, I think shows a market that's sort of slowing, right? It's sort of stagnating a little bit. And I think until you get that rate cut and mortgage rates start to come down a little bit, it's not really going to turn around enormously. But yeah, I think they should be paying perhaps a little bit more attention, particularly on the mortgage side of things.
Sam, great stuff. Thank you very much indeed. Sam Unstead from our Markets Today blog. You can get more on what is happening on that blog. All you got to do is go to the terminal or go to the website. TLIV is the function on the Bloomberg. Let's carry on with that data and figure out exactly what it means. The nationwide data today pointing to maybe stagnation. There had been an expectation that maybe actually house prices would continue to tick a little bit higher, but what we're doing effectively is flatlining now. Maybe the weather's got something to do with that. Maybe it's mortgage rates. That's probably more likely. Tom Bill, head of the UK residential research team over at Knight Frank, joins us now. Morning.
Good morning.
We have seen an impact through into the mortgage market that has been difficult, I think, to discern into housing. So mortgage rates have been sort of bumping around all over the place. People haven't quite known what they're doing, therefore, with what they're going to be getting. And maybe that's now starting to show up in the data. Is that the obvious kind of conclusion from what we've seen today with the nationwide numbers?
I'd say that's probably correct in terms of what's happening around the mortgage market data, also what's happening with the wider economy. We've had mixed signals around inflation over the last few months. I think at the turn of the year, financial markets got fairly excited that we'd have 5 rate cuts this year. And I think that's since calmed back down as underlying inflation has proved more stubborn than people wanted. And I think it's sent mixed messages to buyers and sellers at the moment in the markets. Half of them are probably thinking, well, things are getting better. And the other half are thinking things are sort of still getting a bit worse. And that's probably created a certain amount of friction around prices and asking prices. So it's a bit of a mixed picture. But overall, as we saw today with the data, it's fairly unexciting in the first few months of this year. We still sort of get the sense that we're waiting for something to happen.
How big is the spread between bid and ask at the moment? In terms of the sentiment, I should be selling my house for this, I want to be buying that house for that.
Yeah, you'll probably find it's in double digits in many areas, I would say. I think it's the old story about do you go on at a high price or do you go on at a price where you attract competitive bidding and things get bid up. That's a sort of the debate that buyers and sellers will be having. But at the moment, I think the prices in general are kind of going sideways, if anything. They're not really going up.
Just in terms of that, when houses go on the market, there's limited supply right now. Is there a lot of bids for those houses, which should, in theory, push prices up? Or are people being constrained in their ability to bid higher because they're worried about the mortgage rate that they will ultimately be paying?
I think both those things are putting downwards pressure on prices. So banks are wanting to lend. They're frustrated by what's happening in swap markets because they can't lend after a quiet year in 23. We're seeing more supply now starting to come through, actually, because at the start of the year, people got a bit more positive and supply started to pick up. So more supply, slightly higher mortgage rates has really calmed down, I think, demand over recent weeks. So I think that hence that bit of friction that's come in. You've got more people rolling off relatively favourable fixed-rate 2-year fixed-rate mortgages that were agreed at the start of 2022. So everything's combining to make things a bit sticky at the moment for the housing market.
So you're talking about this kind of stagnation, the sideways movement. What breaks us out of that?
I think it's some certainty. The guessing game over when the first rate cut comes, I think, has to kind of end. And I think we have some certainty, and lenders have some certainty that something's coming in May or in June, wherever it is. And then we'll start to see mortgage rates respond. And I think the market at the moment is really responding to what's happening in the mortgage market.
So what's the lag there between that clarity or indication or sensitivity around the data, for example, and the mortgage story? Do you start to see, because of the lack of direction at the moment, that lag extend?
I think the lags, well, we all know how long it takes to move house. I think the lag, you should start to see the data come through initially in pricing. And that'll take its time to work its way through the system, and eventually transactions will pick up. I think a lot of people have missed the story of this downturn, which has been a fall in transaction numbers, quite a steep fall. Prices haven't done very much. People are taking out longer mortgages. The jobs market's been fairly strong. Transactions have fallen actually pretty steeply compared to the sort of longer-term average. And they are the thing that's slowly starting to pick back up again. So it's a normalisation, but it's sort of painfully slow at the moment.
Are we is there going to be a long period in which prices go sideways? In order we saw a very strong market in and around the pandemic. Prices picked up really sharply. There was a lack of supply. People were trying to move in that period and were bidding up prices. Is this just the hangover effect from that? And if it is the hangover, how long could that last for?
I don't think we're going to see double-digit price growth anytime soon. I think you had a stamp duty holiday as well, which really drove a lot of activity. And a lot will depend on that broader fiscal kind of environment for the market and what the government does ahead of the election. Does it stimulate the market with some demand-side measures? But I think generally speaking, we're not expecting meaningful single-digit or even double-digit growth. So,
is there going to be a permanent effect on psychology? There was a long period of time when interest rates came down, that people got used to the idea that they didn't see volatility, that there wasn't that kind of pain associated with potentially being hit with a much higher mortgage bill at some point at the end of your fix or whatever that was. Do you think that is a permanent shift in terms of psychology, or a more medium-term shift in psychology that will have a profound impact on the market?
I think it's more short to medium term. I think we're going to see most of that pain come through this year. We're kind of almost at the moment at peak pain, because, as I say, those 2-year fixes...
people learned the lesson.
I think people just want stability. So where they see mortgage rates settle at 3.5%, and they don't believe that they're going to fall or rise meaningfully, then I think you will see the market start to pick up.
So previously you'd stretch it because the housing market was rising. You would stretch yourself, therefore you would take on more risk. If we see a period of stability, are we going to see that kind of desire to stretch yourself going to be there? And if there is now this kind of understanding that at the end of the fix you can face a higher cost, that you don't stretch as hard as you would have done in previous cycles?
I think everything about human nature that we know and financial markets means I think people will stretch themselves. And I think they will do that and push themselves to the limit. And I think this year, if things stabilise and people aren't expecting to come off their fixed rate with get a higher rate, then I think demand will pick up accordingly.
And is there any expectation that supply changes if we get a Labour government?
Supply?
New build supply.
Governments, politicians routinely overestimate, I think, their ability to affect how many houses are delivered. So I don't see any particular change in terms of the government changing colour around the supply of housing.
So no shift in planning policy, no major changes?
There could be tweaks to the planning system, but how much that affects how many houses are delivered, I think, is a very open question.
OK. We're going sideways for quite a while. Certainly seems to be the message at the moment. Tom, great to see you. Thanks very much for stopping by and interpreting the data for us. Tom Bill, head of UK residential research, Resi Research, over at Knight Frank. Lines out of Germany.
Lines out of Germany. We were expecting this coming up at about 9 a.m. Looks like it's come out a little bit early. The Germany Lower Saxony March consumer prices riding about 0.5% on a month-over-month basis. On a yearly basis, about 2%. Slight uptick in euro-dollar. It doesn't look like the markets are reacting too strongly to this, but 107.37 is what we have on that story. We're going to dive into those numbers and the broader European inflation story in just a few moments. We're going to discuss not just these numbers, but what we have coming up later today and later in the week. That coming up next. This is Bloomberg. This is Market Stewart. We're about 47 minutes into the European trading day. Green on the screen of the European indexes, but some breaking headlines crossing the Bloomberg terminal right now as we get more inflation data, this time coming out of Italy, and a hot number as we kind of saw in the U.S. as well. Let me break it down for you. We are seeing numbers, manufacturing PMI rising to 50.4. The estimate was 48.8. It's a pretty big
Another strong manufacturing number.
Yeah.
What did we see yesterday out of the United States? A strong manufacturing number. I wonder whether or not we're going to see a little bit of a manufacturing renaissance here. Italy clearly has been juicing its economy in the way that others haven't from the fiscal point of view. Is that a read across as well?
Arguably so is the U.S., though.
Yeah, no, definitely. Yeah. You could make an easy comparison between what's happening. What you're not seeing is that in Germany, which I think is where maybe you're seeing the laggard kind of effect coming through. So I think it's a positive number. It speaks to this idea: is this an economy that needs rate cuts? Does the Italian economy need rate cuts right now?
That's something I don't think anyone's ever asked in the history of Italy. I have to say, I'm curious about getting a little bit more insight here. Let's bring in a true expert. David Powell joins us on set from Bloomberg Economics. What do you make of these numbers? Is this just a purely fiscal impulse, or is there more to it here?
Well, the Italian economy, much like the broader euro area economy, is probably going to be gaining some momentum this year. With inflation having coming down, people's real incomes are going to be up. They're going to be able to buy more, and that's going to help across the board. And Of course, you mentioned the weakness in Germany. Germany is more exposed to high interest rates through its manufacturing sector, which produces a lot of investment goods, than Italy is. So it's no big surprise that Germany remains a laggard in this environment relative to other euro area countries.
Inflation, though, we're going to see a lot of inflation data over the next few kind of minutes. Inflation data in the Eurozone points to the idea, though, that maybe the inflation dragon has been slayed. What is it going to take for the ECB to be convinced of that? And how convinced does it have to be, particularly with this idea that the US economy maybe doesn't look like it's coming in for a landing? Do you think does that change the narrative in terms of the way that the ECB is going to be thinking about its level of conviction that it has inflation under control?
Well, the ECB, over the course of kind of the last year or so, has moved the goalposts. They were focusing on headline inflation for a long time, and then they said core inflation, then core inflation came down, and now their big focus is wage growth. And that's what they're looking at right now in order to cut interest rates. Fortunately, that is decelerating, and it's not come down as much as they would like, but that's probably going to come down more over the course of the next couple of quarters. And the euro area is a very different place right now than the U.S. When we look back to last year, for example, the euro economy did not expand at all, and the U.S. economy expanded by 3%. So they're not in the same league right now. The U.S. economy is much stronger than the European economy, which is hardly expanded for nearly a year and a half now.
So we've talked about the U.S., Italy, Germany. Let's bring in one more country into the mix. There's getting French PMI data out as well for the March numbers. 46.2 is the numbers coming in. The preliminary estimate was 45.8. What is going on in France? How does it differ from the manufacturing story in Germany?
Well, the German economy is much more dependent on manufacturing than the French economy. So the services sector is probably going to be boosted most by the boost to real consumption as inflation comes down, and that's going to help France a bit more than Germany. But broadly speaking, the economies of the euro area are highly correlated. Their performance is similar from one country to the next, and they affect each other. And what we're seeing here is probably going to be this year a broad improvement. It's not going to be a huge improvement, but they're kind of broadly, slowly gaining momentum.
Are we going to see a transmission problem in Europe? If US rates stay high and the ECB, the Bank of England, etc., cut rates, we've already seen the S&P obviously make that move. Is the effect of those rate cuts going to be blunted by the fact that US rates, which exerts quite a big gravitational effect over European bond markets, if they stay high, European bond markets yields don't come down as much? If we do need to see rate cuts in Europe, are the effects going to be limited, and therefore is there the potential for actually the ECB, the Bank of England, going to have to do more to get the same effect into their economies?
Well, what really matters for the economy is the interest rates that businesses and households face when they want to take out loans for various reasons. And what we saw on the way up when the ECB was hiking was that these rates were being the rate hikes were being almost fully transmitted into rates that are available at banks. We've got data on that from the ECB. And so there's no reason to think the transmission isn't going to work just as easily on the way down and be felt throughout the economy, giving businesses and consumers some relief.
Well, then let's talk about the contagion, if we can, though. In just a few minutes, I believe we're also going to get those final manufacturing PMI readings out of Germany as well, on top of the data deluge that we've got in the last couple of minutes. The conversation has arguably been, is Germany the sick man of Europe? It's quite clear that they're underperforming on the data front, on the economic front, you name it. At what point are the other European economies that are showing strength right now affected?
I mean, I think we shouldn't exaggerate the picture either. It's not like Germany is this case of extreme weakness and the other economies are booming. Germany is a bit weaker than the other economies, but there is a broad-based weakness across the euro area that has come about as the ECB has hiked interest rates at the fastest pace in its short history. The only problem is that's probably been a bit more difficult in Germany because of its exposure to industries that are very cyclical, much more so than the other economies, which have larger services sectors, and the services sector is just less affected by higher interest rates because people still need a haircut and still buy consumption goods and things like that when interest rates go up. But what they don't do is they say, oh, well, maybe I don't need a new car right now. I can wait until next year when interest rates go down. Or if a big company wants to buy some big machinery or something, they think, oh, well, maybe I can wait until interest rates come down. And that's really what's plaguing Germany at this stage.
A lot to digest there. David Powell, senior Euro area economist over at Bloomberg Economics. We thank you so much for breaking down really just every data point across Europe that we just threw at him. In addition to some of the data points that we're going to be waiting for in just the next 30 seconds, let's take a quick look at what's coming up in the week ahead. That Germany CPI number, as I mentioned, the March prelim numbers are coming out shortly. Plus those Fed speakers, Bowman, Williams, Mester, and Daly, all looking to speak on Wednesday. You've got the NATO foreign ministers meeting, the Euro area CPI numbers, some March preliminary data there, as well as Fed Chair Jerome Powell speaking on the U.S. economic outlook. On Thursday, more Fed speakers, Harker, Barkin, Goolsbee, Mester, and Kashgari. We should mention some of these speakers are speaking twice in 1 week, so that is worth
anybody
mentioning.
Not speaking?
I haven't gone down the checklist, and I haven't done a quick attendance check by everyone, but maybe we'll do that on Friday.
Yeah.
U.S. initial jobless claims that day as well. We should mention it's also the 75th anniversary of NATO as well. And on Friday, U.S. payrolls and jobs data, the 35th Ambrosetti event kicking off on the shores of Lake Como. I believe our very own Francine Lacqua will be there. And on top of that, the EU and the United States meeting for their Tech Council meeting. So there's actually a lot going on in the monetary policy space and the geopolitics as well.
We've got a bit more data coming out. March manufacturing PMI, these are the final numbers. You get 41.9 out of Germany, 41.6, the preliminary number. I think that's a very small difference. The fact that it's got a 41 handle still tells you everything you need to know, to your point about what's happening with German manufacturing right now. Yeah, it looks, this week is going to be, this week has the potential for a little bit of volatility. I'm genuinely fascinated to see, A, how the European data come through, but B, how coalesced is the FOMC in terms of the idea that we will see a June rate cut? And if we're not, then potentially a bit more pricing still to come through in both sides of the Atlantic's bond market.
I mean, pricing to come through, but then also I wonder if you start to see that divergence, do people just look at it and say, hey, we're not going to touch it? Is that reason to not engage or to have even less volatility than what we're seeing right now? I could see a kind of wait-and-see approach.
Absolutely.
After this conversation.
So a lot of Fed speak. Jolts are coming out a little bit later on today. We've got payroll data coming out on Friday as well. It's actually quite a busy week, and I think the geopolitics is something, to your point that you made at the beginning of the programme, is not something we can ignore either. How does Iran react to the attacks that we've just seen? Is that something that ultimately could impact oil prices as well? Were you to see potentially an attack on Saudi oil facilities, for instance? That's something that the market is not discounting right now.
Not discounting. There's hedges in play. Is gold a hedge story? Is gold something else? We don't really know. But I'm sure it'll all shake out. To me, it's the theorizing behind the Fed speak for me. That does it for markets today. The Pulse is up next. Stick with us. This is Bloomberg.